Hi guys, this is Tony Javier, founder of Real Estate Prodigy, as well as Professional Home Buyers, which was named as one of the fastest growing companies in the United States, according to Inc. 5000 magazine. So what I'd like to do now is to talk about why real estate is so ideal. That's ideal, I.D.E.A.L. It's an acronym that I'll explain here in a minute. But before I do that, I want to talk about how I used to be in stocks. So when I first got in this business in 2001, I started investing in stocks. And people said, well, if you invest in these types of stocks, then your investment is almost guaranteed. And so I went and I found a stock, and they'd been around for a long time, very consistent and stable. And I basically put all my money, all my eggs in one basket, something I probably shouldn't have done at the time. And literally within 2 weeks, that stock had plummeted 40%. First time it had ever done that before. And I realized the stock market wasn't for me. And eventually, actually probably just a year or two later, I actually found real estate. And I realized that real estate is an ideal investment, and that's what I'd like to share with you now, because it's so much more consistent, it's a tangible asset, and something that you're more easily able to control rather than a company that maybe has a CEO that's doing things that they're not supposed to be doing, if that makes sense. So let's talk about I.D.E.A.L. So the I stands for interest deduction. So when you're investing in real estate, you can deduct the interest on the property for a loan that you may have on the property. You can deduct the insurance, you can deduct the taxes, and you can deduct anything else that's an expense on that property. And not only that, but if you start creating a business out of it and you can prove that you're doing it on a more consistent basis, you can deduct some of the things that you already do in your normal life. So your cell phone, your car, your gas, there's so many expenses that I have that I would normally have in my personal life anyway, that I can now deduct because I'm in real estate. Very powerful. So let's talk about now the D, the depreciation. This is unbelievable because even though real estate's typically going up in value, the government has allowed you to deduct or depreciate your property over a certain amount of time. For residential, it's 27.5 years. For commercial, it's 39 years. So for a residential property, if you have a property that's worth $100,000, you can't deduct the land. So if the building itself is worth $100,000 and you depreciate it over 27.5 years evenly, that's over $3,000 a year that you can deduct on your taxes, even though you're probably making that amount of money, which helps offset it. In fact, for the first 5 to 10 years I was in business, I accumulated a lot of rental properties, and while I could show pretty good income, I was able to offset a lot of that with the depreciation. So it's basically tax-free income that I was earning in my business. So let's move on now to equity. So there's two different ways that you can accumulate equity, which to me is is super powerful, because equity is where you start building wealth. And so let's talk about the two different ways that I build a lot of equity and have and continue to over time. So the first way is buying properties right. So if you buy a property that's worth potentially $100,000 and you've only have $70,000 invested in that property, you've got $30,000 in equity in that property. We're buying and holding 1 to 3 of those properties every single month. So that 20 to 30%, that example I gave was 30%. The worst case for us typically is about 20%. So if you've got 20 to 30% equity in properties that you buy, you're building net worth, and that's where it's at, you guys. Not only do you want to have good income, but you really want to build equity, which equates to net worth. The second type of equity that you can build up is mortgage pay down, paying your mortgages down. And so when you buy a property and you put a tenant in there, they're paying your mortgage, you get all your deductions, and your mortgage is actually being paid down. And so I've got properties that I bought 15 years ago that are now paid way down, and some that have already paid off. And the great thing about that is the tenant is the one that helped pay that equity, help build that equity by paying your mortgage down. Okay, so let's move on now to appreciation. So I talked about earlier how you can depreciate properties even though your values are going up. So your values going up are what we call appreciation. So appreciation is typically between 2% and 10% per year is what the property goes up. It depends on what market you're in. If you're in some of the bigger markets right now that saw a big decrease, your appreciation rates are much higher. You know, I've seen appreciation rates anywhere from 5% up to close to 20% in some markets that may be a little bit overinflated right now, but nonetheless have appreciated. In the markets that I invest in, which are the Midwest, which I feel like are very stable markets, you're not going to see the big ups, but you're also not going to see the big downs, which makes it much safer. We see about a 2 to 5% appreciation per year. And even in the downturns, the bad markets that I've seen, in the Midwest, I've only seen a very small dip, if any, in some of those down markets. And when I say down markets, I'm talking about the times a year or the years in the past where the market has gone down as a whole in the United States, like back in 2007. So let's now talk about leverage. Leverage is one of the most favorite things I like talking about because it's really what helped build my business. You know, we bought, tens of millions of dollars in property without using any of our own money. And even the properties we used using our own money, we're able to leverage highly. So let's take an example. Let's take an example of a $100,000 house. If you were to go buy a $100,000 house right now, as a homeowner, you could put down 3.5% and get an FHA loan and own a $100,000 house with only $3,500 out of your pocket. As an investor, typically it's at least 10%, if not 20% down is what you need for a loan. So even at that, if you had a $100,000 property you're controlling as an investment, you only need $10,000 to control that property. Whereas if you were to go buy stocks, if you were to have $10,000 and went to go buy stocks, you would have to buy $10,000 worth of stocks. And so if you add up all of the other benefits of paying a mortgage down and appreciation and depreciation and all those other things, it blows stocks out of the water, completely blows them out of the water. And so that's why I like real estate, is because I can leverage highly a lot of assets with a little bit of money. And the second part of leverage is when you buy a property and you have a lot of equity, you can actually borrow 100% of what you have into the property. So let's take that example of a $100,000 property again. If you can buy that same property for $50,000 and put, let's say, $20,000 into it, which we do a lot, those types of numbers, you can borrow that $70,000 to buy and fix up that property and use your 30% equity that you have in it, the difference between the $70,000 that you have into it and the $100,000 it's worth, as kind of your down payment, as your virtual down payment, if you will. And so you can go and you can borrow 100% of that deal and have no money out of your pocket. In fact, we still do that to this day. We do buy properties with our own money, but a lot of the time we buy properties with other investors' money so that we can buy so much more. And again, we bought tens of millions of dollars worth of properties without using any of our own money. It's so powerful to be able to do that and have an investment that you control, that's tangible, and you have so many other benefits to put into the mix. So by now, I hope that you understand how ideal real estate is for an investment. And if you're not already in real estate, I would imagine that by watching this video, you're probably pretty intrigued on how to get started in real estate. So what I want you to do now is go down at the bottom of this page and click on the link below so you can learn more how to get started in investing in real estate. Because you guys, real estate really is not only an ideal investment, but it's a very simple, easy way to build a lot of wealth very quickly. This is not a get rich quick necessarily type of business, but it's a get rich quicker business. You can get rich so much quicker with real estate than you can any other investment. And guys, don't forget to consult with a tax advisor before you start implementing any of this. Because before you get started, you want to make sure you get your business set up and get things set up so you're doing it right the first time. So thank you guys, and I hope that you get started investing in real estate today.